I pulled up the CME warehouse reports this morning, grabbed my coffee, and looked at the daily movement data, and I saw a specific pattern that, frankly, most people are completely misinterpreting. You look at the headlines, and they tell you silver inventories are stabilizing. You look at the total ounce count, and it looks flat. But if you look at the movement from one category to another, you see a completely different story. It looks like a shell game designed to hide the fact that the metal available for delivery is getting dangerously thin. That is not what you're hearing on the news because they don't bother to read the line items. And I think you deserve the full story. So here it is. It is Sunday, February 16th, 2025, coming to you on Chicago time. Comment what day and date you're watching from, because I'm always curious how far this travels and where you are in the cycle when you hit play. Quick thing, I'm running a campaign to eliminate copycat channels. If you value this breakdown and the work that goes into tracking these ounces, support it by subscribing and commenting Vault Watch below so the algorithm knows who the actual humans are. Here is the problem. The mainstream narrative looks at the headline number of total silver in COMEX vaults and says, look, there are hundreds of millions of ounces, there is no shortage, go back to sleep. But the real story is the composition of that inventory. Most of that metal is not for sale. It is private property that just happens to be parked in a COMEX-approved building. The registered inventory, the stuff that is actually available to settle a futures contract, is bleeding out, which means the leverage ratio of paper claims to real deliverable ounces is skyrocketing. And you don't hear that part in the mainstream narrative because explaining warehouse warrants is boring until the moment the default happens. I'm going to break down 3 things for you, and I'll keep it practical. First, I want to explain the eligible versus registered shell game and why the total number is a lie. Second, we need to talk about the load-out velocity and what it tells us about wholesale demand. And third, I want to discuss the concentration of ownership and why the free float is much smaller than you think. Before we get into the details, let me say something to newer people, or if you're just getting started. Don't let anybody shame you for finding these reports confusing. They are designed to be confusing. They are designed by lawyers and accountants to satisfy a regulatory requirement without giving away the game. If you don't know what a warrant is, don't worry. That's what we're here for. And for the experienced traders watching this, here's a retention trick. Whenever you see a massive transfer from registered to eligible without the price dropping, that is bullish. That is someone taking metal off the market and putting it in their private safe. Let's start with the first major point, which is the eligible versus registered dynamic. The principle here is crucial. Registered metal is the inventory on the dealer's shelf with a price tag. Eligible metal is the car parked in the customer's driveway. Just because the car is in the city limits doesn't mean you can buy it. The mechanism works like this. When metal enters a COMEX vault, it usually starts as eligible. It meets the purity standards, it's in the right place, but it has no warrant attached. It belongs to a private entity, a bank, or a wealthy individual. To make it deliverable against a futures contract, the owner has to issue a warrant. That moves it to registered. That is the only metal that backs the paper price. Recent reports show a consistent trend of metal moving from registered to eligible. This is what we call category drain. The metal is still in the building, so the total number looks fine. But it has been removed from the pool of available liquidity. It's like a store that looks full through the window, but when you walk in, everything has a sold sticker on it. The hidden consequence is that the market is much tighter than the headline number suggests. If registered inventory drops to 30 million ounces and open interest represents 300 million ounces, you have a 10-to-1 claim ratio. But if half of that registered metal is actually spoken for by banks who won't sell, the ratio might be 20-to-1 or 50-to-1. The common mistake is assuming that eligible metal will easily flow back into registered if the price goes up. People think, oh, if silver hits $35, all those eligible owners will sell. Maybe. Or maybe they are holding that metal because they don't trust the dollar. If they refuse to sell, the eligible pile is useless to the shorts who need to cover. Now here's the skeptical alternative. Could the banks just flip a switch and move millions of ounces back into registered to crush a squeeze? Yes, they can. They have done it before. J.P. Morgan or Citi can move metal around to paint the tape, but every time they do that, they are using up their own strategic reserves. They can only play that card so many times. That brings us to the second thing, which is the loadout velocity. This is the most honest data point we have. The principle is simple. Money talks, but a truck leaving the vault screams. A loadout means the metal didn't just change categories, it physically left the building. It was put on a truck or a plane and removed from the COMEX system entirely. The mechanism is final settlement. When a bar is loaded out, it is gone. It is likely going to a factory to be turned into solar panels, or it is going to a private vault in Singapore or Zurich. It is no longer part of the Western pricing game. Based on the latest publicly available data, we are seeing a steady, relentless drip of loadouts. It's not a flood. It's a leak. But it's a leak that never stops. Day after day, 300,000 ounces here, 500,000 ounces there. It adds up. The hidden consequence is that the COMEX is slowly losing its relevance as a physical storage hub. It is becoming purely a paper trading venue. If the physical stock gets too low, the exchange becomes vulnerable to a run. Just like a bank run, if everyone asks for their metal at once, the trucks can't move fast enough. The common misconception is that inflows equal outflows. People see a deposit and think, oh, supply is coming back. But often those deposits are just shuffling between vaults. The net drain over the last 2 years is undeniable. The trend is down. Now here's a question for you. If you owned $1 million worth of silver, would you leave it in a COMEX vault where the rules can change? Or would you take delivery and move it to a private depository in a neutral jurisdiction? Drop that in the comments because I want to know how much trust you have in the system. Now, add the third ingredient on top of that, which is the concentration of ownership. This is reading between the lines. The principle is that a whale behaves differently than a school of fish. If the registered inventory is 30 million ounces, but 25 million of that is held by 2 major banks, then the free float, the amount available for everyone else, is only 5 million ounces. If you are a stacker, ignore the daily fluctuations in the total number. Focus on the trend. The trend is that metal is leaving the system. That validates your thesis. Keep stacking, but do it in your own possession. Don't pay storage fees to a system that is bleeding. If you are a trader, watch the ratio of registered to open interest. When that number stretches, volatility is guaranteed. That is your signal to hedge or to take profit on the spikes. For everyone, understand that the price of silver and the availability of silver are decoupling. You might see a low price on the screen, but be unable to find product. That is what the warehouse report is warning us about. Here is a simple approach. 1. Check the registered category, not the total. 2. Look for loadouts versus deposits. Net negative is bullish. 3. Watch for sudden large transfers from eligible to registered. That usually means a bank is preparing to smash the price by dumping supply. So, here's what we covered. The total inventory number is a mirage masking the real tightness in registered metal. The steady stream of loadouts proves that big money is taking possession and leaving the system. And the concentration of ownership means that the available float is much smaller than the public realizes. The drain is real. The reports confirm it if you know where to look. The mainstream ignores it because they are trading tickers, not metal. Now, here are my questions for you. Do you trust the audit numbers of these vaults? Do you believe the metal is actually there, or do you think there is a re-hypothecation game going on? Drop your answer below and remember to include what day and date you're watching from. If you want to support this channel and keep this campaign strong against the copycats, subscribe right now and comment Vault Watch. And if this helped you, share it with someone who thinks a paper receipt is the same thing as a silver bar. All right, take care of yourself, stay sharp, keep your head clear, and I'll talk to you soon. And just so we're crystal clear, this is educational commentary. It's my take, based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. You make your own decisions and you own the outcomes. Do your own homework, consider your situation, and only take risks you can actually live with.